What's up, audit fans? Dr. Amanda White here from Amanda Loves to Audit, and we're here with the next video in our series on explaining auditing standards, and we're looking at ASA505 about external confirmations. Remember that everything in the 500 series is specifically related to the collection of what ASA 500 calls sufficient and appropriate evidence. Now within ASA 500, they also talk about a number of different procedures. So the sorts of things that we could have include inspection, and remember I actually break that down into inspection of documents, and then I also have inspection of physical or tangible assets. We have inquiry, which is simply just talking to people. We have recalculation, analytical procedures. We have confirmations, which is what we're going to look at today. We've got reperformance, and we've got vouching, and we've got tracing. I'm missing one. What is it? Inquiry, analysis, confirmations. I remember which one I'm missing. Observation. So the ones I'm going to highlight are the ones that are actually listed in the explanatory material of ASA 500. So that's inspection of both sorts, inquiry, recalculation, analytics, confirmation, reperformance, and observation. The two extra that I always add is that I split inspection into documents and physical assets, and then I also look at vouching and at tracing. So today our focus is on the item of confirmations. When we look at our table of contents, this isn't anything really new, structured like most of our existing standards. An introduction that talks a little bit about what the standard is about. The introduction and objective are quite similar. Then we've got definitions. The bit we're interested in is this requirement. So that's our legally enforceable section. Down here at the end we have the explanatory material. As usual, I don't go into that, but it's always good to read up because our explanatory material really tells us how we go about applying our requirements. The scope of the standard is pretty simple. We have to use external confirmation sometimes. We're not looking at litigation and claims because we looked at that separately, but it says really, what do we need to consider when we're talking about confirmations and what's the best way to go about collecting evidence from a confirmation. There's some general information about confirmations. One of the reasons why we have confirmations is that we know we need to look at reliable and relevant evidence. So evidence is more reliable when it's obtained from independent sources from outside the entity. I'm going to label that with a caveat of sometimes, and I'm going to explain that little bit about sometimes a little bit more. And there's a couple of other things here. Evidence that we get directly is more reliable than if somebody else gives it to us. And it's more reliable when we get a document, and that could be paper, electronic, or other medium. So in some of the instances, I will say that when we get it directly, usually more reliable, I'll agree with that one. More reliable in a documentary form because people are perhaps less likely to be false in a document than they are if they were just speaking to you. But this one here, about audit evidence is more reliable when obtained from independent sources outside the entity, I'm going to put as a maybe, as a sometimes, for some factors that I'll talk about later in the video. So let's look ahead to some definitions. All right, and the objective is pretty straightforward. When I use a confirmation, I want to make sure that I design it in a way that I get relevant and reliable evidence, because it is possible to use a poorly designed confirmation, and that might not give us evidence that is actually going to tell us what we need. So let's look at the definitions to make sure we're all on the same page here. Definitions. So an external confirmation is evidence obtained by us as a written response to the auditor from a third party, and it can be in a number of different formats. So what this really means is that what the auditor does, let's draw our little auditor there. You can tell I'm not very great at drawing people. This is our auditor. Our auditor writes a little letter that addresses to the third party, can you please confirm some information to me? That little letter goes off in the post, and then what happens is our person, our external party, so let's put a little E there, our external party that we're getting to receives the letter, they read it, and they will send something back to the auditor to confirm. Now we've got different types of confirmations, and these are contained within the definitions. We're going to look at a positive confirmation, which means that you have to reply whether you agree or disagree. If you say yes or no, so we require a response either way in a positive confirmation. The negative confirmation is a response, so we respond only if they disagree with the information provided. Now that has some real issues because there are a number of reasons why somebody might not respond to a confirmation. The company may have moved and they're not at that location anymore. The company might be, they may have gone out of business. And if the company has gone out of business, then it is entirely possible that if you don't know that and you have a negative confirmation, then you think, hey, everything's okay. So they might have gone out of business. They may choose not to answer. Lots of companies, big companies, will get lots of confirmation requests. And it's quite common when you talk to some clients, what happens when you get a confirmation request? It's a negative confirmation, throw it in the bin. So with a negative confirmation, we assume here that everything is correct if we receive no response. So I'm going to include that right there. So under the assumption with a negative confirmation, this means that for any of these reasons, they might have moved, they've gone out of business, they might choose not to answer, I might assume the information is correct even though that's not the case. So the positive confirmation, if you're going to use a confirmation, the positive confirmation is always the one. So what do the requirements say? Remember, these are our legally enforceable parts, and the requirements say, well, when I use external confirmations, I should have control over the confirmation request. So I should be able to figure out what's to be requested. Is it an accounts receivable balance, an accounts payable balance? Select the confirming party. Now what that means is that I actually need to have control over the sampling process. So the client does not choose the sample. I choose the sample as the auditor. I also need to make sure that the confirmation requests are returned directly to the auditor. So the reason that they don't go via the client is because we're trying to reduce manipulation by the client. I, as the auditor, have to also send the request and any follow-up requests. So I don't get the client to do this, I do this all myself. So if I was doing this for accounts receivable, for example, let me do this in a different color. So if I was doing this for accounts receivable, I'd get a list of debtors and amounts. All right. I would then need to make sure that I select a sample, generate an appropriate letter, and then post that to the debtor. Okay, and then the debtor is going to send that information back to me. Now it is possible, and it says here in this last one, management's refusal to allow the auditor to send a confirmation. So sometimes, because remember, we're contacting their customers or their suppliers, so they might say, well, we're not going to allow you to do that. what happens then? Well, as we go up here, first we want to ask the question, why? Why don't you want us to go talk to these people? Are you hiding something? Do they seem suspicious? So my first question is going to be why. Then I have to look at, well, what's the implication of this? Is this perhaps an indicator of fraud? We think about the fraud triangle. Is there something in the fraud triangle that could be going on? And then I have to perform alternative procedures. All right, so I have to do something else. I can't not collect any evidence. We talk to management. They don't give a valid reason for refusing. I think this could be an indicator of fraud. I do alternative procedures, and I might still not get some evidence. Well, if I conclude that when they refuse to send allow us to send the request is unreasonable, and I can't get reliable evidence from somewhere else, then I need to communicate with those charged with governance. All right, remember that's typically going to be our audit committee. All right, we want to go to them because they're independent, and I have to consider the possibility that under ASA505, I might have to have a scope limitation, an inability to collect sufficient and appropriate evidence. Now, remember before when I said, the positive confirmation or the confirmation could give us some evidence, and I said sometimes. So back on a previous slide, I said there's the possibility of sometimes things might not be so great. So I have to consider the reliability of the responses to the confirmation procedure. So when I send the letter out and I get it back, I have to think, well, is this reliable? That reliability will depend on the quality of the internal controls at the recipient of the letter. All right, so if I send a confirmation to a very small company that might not have great accounting, then that response is not going to be terribly reliable. So I need to think about the quality of internal controls. Have we had any misstatements with them in the past? Is there any risk? Is the company reliable? Are they reputable? If I was sending a confirmation to a company that was known to be not reputable, then I'd worry about the reliability of the responses. So there's going to be a lot of issues around how do we assess who is a good person to send a confirmation request to. That is why it is always very common, so common practice, to send confirmations only to large clients or large recipients. That is because they are the ones who are more likely to have internal controls that are going to be good enough to allow them to accurately respond to the confirmation request. And this comes about because there's also a potential for bias within confirmations. So I'm just going to move across here and I'm going to create some extra space to talk about that potential bias. So let's say that we have the reports, and it says that client A owes $100,000. All right. So let's say in the confirmation, you send a confirmation request. Oh, you can hear my dog barking in the background there. Say we send a confirmation request and we send to them and we say, hey, do you owe $150,000? All right. And that client's going to write back and they're going to go, no, 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 no. This is the amount that I owe here. Okay. So if we've overstated an amount, people are likely to speak up and say something. But what happens if I said, I'm going to send a confirmation, and in that confirmation I've said, well, do you owe $80,000? Now we know that if the actual number was $100,000, but we sent them an amount that was smaller, the client or whoever it is that we're sending it to is actually going to say, yep, So there's the potential when we've understated accounts compared to what it should be, people are going to respond inappropriately. If we've overstated, people will always say, oh, no, we don't owe that much money. But if we've understated, someone's going to go, oh, yes, all right, that particular customer has thought that they've made themselves a $20,000 saving. So confirmations are really only great to test the existence of the recipient of the letter and to test for valuation, but only when it comes to overstating accounts receivable and understating accounts payable. So there are going to be some disadvantages to using the confirmation as a really comprehensive test. Now, back to the standard, where the standard says here, well, what do we do about non-responses? And this is quite common. In my practical experience, when we talk to auditors, we say, okay, how many would you send out and what would be the response rate? And my sort of anecdotal evidence is that something like only 10% of people actually respond to a confirmation. And this makes it an expensive exercise. You know, you send out the confirmation, letters, stamps, envelopes, all the rest of it. Only 10% of people respond. You take 90%, send them a second letter as a follow-up. When we have non-responses, I have to perform what they call an alternative procedure. So what sort of things are alternative procedures? I'm just going to make myself some more room here. So for accounts receivable, and the same applies for accounts payable, an alternative procedure is something like a subsequent cash receipt test. All right, and how a subsequent cash receipt test works is that you've got your financial period here, you've got your end of financial year, the customer owes a certain amount of money at this point. You go, usually whatever the payment terms are, let's say it's 30 days, so you're looking at 1 month after. We look at cash received and we see if that cash received actually matches up with the amount of money that they owed back here. And if it does, then the subsequent cash receipt confirms the existence of the accounts receivable and the valuation of it. So there's a subsequent cash receipt test, and there's also something called the subsequent cash payment test, and that's what we would use for accounts payable. So, you know, most confirmations are accounts receivable or accounts payable, but you might also have bank confirmations. So there's lots of different types of confirmations, but those are the most common, and these are the most common alternative follow-up procedures. Now, what happens if I need to get a positive confirmation and an alternative procedure will not give me the audit evidence that I require? If I can't get the positive confirmation response, then I have to consider the implications for the audit. And what that's really saying is that I need to consider the possibility of what we call a scope limitation, an inability to gather sufficient and appropriate evidence. Now, I've mentioned negative confirmations before, but the standard actually reinforces negative confirmations, less persuasive evidence. All right. We shall not use negative confirmations as the sole substantive audit procedure. So you might use it in combination with something else. But realistically, a negative confirmation is probably not something that you want to send out, because it's almost always going to result in the need for you to do some form of alternative procedure. All right. And realistically, this just creates a time delay. Negative confirmations or any sort of confirmation process does create a big time delay. You have to get the list of people that you want to send a confirmation to. Usually, it's going to take you, and let me make some more room here. Timeline usually works something like this. So you need probably 1 week to get the details, send the confirmations and wait. Then you've got, I just realized I've got a spelling error there. wait another 2 weeks to send out another range of confirmations, wait. All up, this could be a 6 to 7 week process. Now, most of the time, our end of financial year audits need to be done within this period. When I once talked to a number of partners, and this was probably like a good 15 years ago, and I was learning about confirmations at university, and I had all these questions about whether it was a good procedure or not, and I asked audit partners at the firm I was at, why are we using confirmations? Why do we have to do confirmations? And this is the reason why. They said, we do confirmations because it's tradition. And I said, they're not very efficient, they're not very effective, they're expensive, so why on earth are we doing a procedure just because it's a tradition? What we're seeing now from a lot of firms is the option to opt in for confirmations in a lot of circumstances. Now, bank confirmations, we're always going to do a bank confirm, but when I was mentioning these confirmations from the tradition perspective, I'm mainly talking about accounts receivable and accounts payable confirmations, but a lot of audit firms now are only going opt-in. So we only do confirmations if we have a really good reason. Most of the time, other alternative procedures are what is being done. So once we have our confirmations, last thing we have to do, evaluate the evidence, all right? Is it relevant, reliable? Does it help test the assertion? In a lot of circumstances, we're going to do a confirm, if we are going to use a confirm, plus other tests. All right, remember I mentioned before that the confirm is a great way to test the existence of something, valuation in only one direction, but it doesn't tell us about rights and obligations. It doesn't help us with completeness at all. So we're still always going to need to do lots of other tests to help us gather sufficient appropriate evidence over the entire set of accounts. All right, that video ended up going a bit longer than I thought. It's only a short standard, but there's actually quite a lot of ancillary information that goes around confirmations. I hope you enjoyed the video. If you thought it was great, I'd love a thumbs up. You can always catch me on all of my social media channels, and I will see you in the next video. Thanks for watching.